The single hardest habit to break is believing that hard work is the same thing as wealth. It's 11:30 p.m. on a Tuesday. You are 24 years old. You are standing in the small, cramped bathroom of a dilapidated duplex on the wrong side of the tracks in Columbus, Ohio. You are wearing a pair of work gloves that are already soaked through. You are currently augering a toilet that has overflowed for the third time this week. The tenant in Unit B is currently shouting at you from the hallway. You barely qualified for the mortgage on this building. You used an FHA 3.5% down payment loan. To get the $6,000 for that deposit, you worked double shifts as a junior underwriting analyst and didn't eat out for 8 months. When you look in the mirror tonight, you don't see a real estate mogul. You see a tired, humiliated kid covered in dirt, drowning in a liability that the neighbors call a dump. You need to remember this feeling. You need to anchor it in your mind. Because in 16 years, you are going to leverage the math you learn on this very toilet to acquire a $14 million apartment complex without using a single dollar of your own money. This isn't a story about working hard. This is a step-by-step masterclass on how to construct the machine, the intersection of equity optimization, tax engineering, and the two most powerful wealth vehicles ever created, the Refinance-to-Expand Mechanic and the Section 1031 exchange. The biggest mistake amateur investors make is trying to scale before they have stability. They want 50 doors, but they can't even manage the cash flow on one duplex. At stage 1, you have no leverage. You only have your saved income. Your primary goal is not cash flow, it's force appreciation. You need to utilize the only financial model that allows an ordinary person with limited capital to force equity creation from thin air, the BRRRR method, which stands for buy, rehab, rent, refinance, repeat. Look at that initial duplex you bought for $140,000 in 2010. You used the FHA loop, putting down just $4,900. You lived in Unit A and rented out Unit B. Unit B's rent covered 85% of your mortgage. This is house hacking, the psychological foundation of wealth, where you utilize a liability to neutralize your cost of living. While others were spending $2,800 a month to live in a modern apartment they leased, you were living in a property you owned, paying $200 a month for housing and channeling your remaining salary into phase 2 of the machine. For 2 years, you lived in that duplex and applied every spare dollar of your underwriting salary toward forced appreciation. You didn't buy new furniture, you bought a new furnace. You learned how to drywall Unit B yourself. You updated the kitchens with stock cabinets you found on discount. You spent $15,000 in raw materials and 2 years of physical labor. When you were finished, the local market in Columbus had stabilized, but your physical renovations had transformed the property's value.
In 2012, you approached your original bank for your first cash-out refinance. The bank appraises the property at $220,000. You force-created $80,000 in pure equity. The bank moves you from the original FHA loan to a structured 80% loan-to-value conventional mortgage. They pay out the remaining FHA balance and hand you a check for $36,000 in tax-free cash liquidity. Look at the arithmetic of Phase 1. You used your labor and $15,000 in savings to unlock $36,000 of the bank's capital. Your original $4,900 investment is still in the deal, but you just manufactured enough liquidity for your next acquisition without waiting for another raise at your day job. Repeat. You take that $36,000 and buy another, larger distressed triplex 2 neighborhoods over using an investment-grade 20% down loan. You execute the BRRRR method again. This is where you master the math of the machine. You aren't fixing toilets anymore. You are hiring project managers to fix the toilets while you analyze the numbers. By 2015, you own 7 units. Your portfolio value hits $1 million. You are standing on your porch, your old gray pickup truck by the curb, drinking coffee. You're in a simple navy sweater and dark jeans.
You are quiet. The neighbors think you are a struggling contractor. They don't know you are cash flow positive and your net worth is accelerating. Phase 2, the Refinance-to-Expand Mechanic. $1 million to $5 million. At this stage, you are facing a massive psychological and mathematical bottleneck, the equity trap. Amateur investors see their portfolio grow from $1 million to $2 million. They are generating healthy net cash flow. They get comfortable. They use that cash flow to finance a better lifestyle. They would buy that new luxury SUV now. They are trapped because all their value is dead equity. If your property is worth $500,000 and you only owe $200,000, that $300,000 of equity is sitting there, generating 0% yield. To scale beyond $1 million, you must stop valuing cash flow and start valuing equity efficiency. You transition to phase 2, the Refinance-to-Expand Mechanic. Look at your diversified 7-unit portfolio in 2016. It is appraised at $1.8 million. Your combined debt is $900,000. You have $900,000 in total debt equity. Instead of waiting, you initiate the institutional refinance loop. You don't approach your local community bank anymore. You move to a regional private bank that structures advanced portfolio mortgages. You package all 7 units into a single legal entity and cross-collateralize the debt. The bank executes a structured 75% loan-to-value refinance against the entire $1.8 million portfolio. They pay out the existing $900,000 in debt and hand your LLC a treasury check for $450,000 in 100% tax-free liquidity. Look at the arithmetic of phase 2. You just pulled nearly $500,000 of the bank's capital, utilizing your forced equity appreciation as the only collateral. You did not have to earn that money. You simply engineered its release. Now you have liquidity, and the machine is fully automated. You take that $450,000 and move up the food chain. You don't look at single-family homes or triplexes anymore. You utilize that liquidity to acquire your first truly commercial asset, a 12-unit brick apartment building in an accelerating market near a state university. This is where you master commercial real estate CRE valuation math. Residential property is valued on comparable sales, called comps. Commercial property is valued on a strict mathematical formula. Property value equals net operating income divided by capitalization rate, or cap rate. By implementing streamlined management, optimizing rental revenue, and implementing common area maintenance, CAM, reimbursement, you increase the net operating income of that 12-unit building by 15% in 2 years. You compress the cap rate and force the commercial value from $1.2 million to $1.9 million. Repeat the BRRRR cycle on the commercial asset. The machine is accelerating. By 2020, you own 28 units. Your portfolio value hits $5 million. The neighbors are out washing their new leased luxury SUVs. Mrs. Gable, the self-appointed neighborhood watch leader, is completely confused why you were always home at 10 a.m. on a Tuesday. You are cash flow positive, and you are quietly executing the refi loop to manufacture the capital for Phase 3. Phase 3, the 1031 exchange pivot, $5 million to $15 million. At $5 million in portfolio value, you are standing face-to-face with the single biggest enemy of wealth creation, structural tax liability. You have been utilizing the BRRRR method and refinance loop for 10 years. It has worked perfectly because cash-out refinances are debt, not income, and therefore 100% tax-free. But you have reached the limit of that model. Your properties are now stabilized. You cannot force any more significant appreciation. More importantly, your personal debt obligations are approaching institutional covenants. You cannot safely leverage much further. To scale beyond $5 million, you must stop utilizing debt to expand and start utilizing the single most powerful tax engineering vehicle allowed by the legal code, the Section 1031 like-kind exchange. Section 1031 of the Internal Revenue Code allows you, the commercial investor, to sell a business or investment asset and defer 100% of the capital gains taxes and depreciation recapture as long as you reinvest all the equity proceeds into a new like-kind asset of equal or greater value. You must execute a clean break. You must sell your entire initial portfolio. This is the hardest pivot. You are attached to those 7 units in Columbus. You know the tenants. You know the brickwork. They generate cash flow. Real high finance literacy is about calculated detachment. You must sell. Look at the arithmetic of Phase 3. It is 2021. You list your diversified 28-unit residential portfolio for sale. The portfolio sells for $6.4 million. You pay off the bank's $3.1 million portfolio loan. This leaves your LLC with $3.3 million in net cash equity proceeds. Normally, you would owe a combined federal, state, and depreciation recapture tax bill of nearly $800,000 on that sale. But your LLC utilizes a qualified intermediary, or QI, to execute a structured 1031 exchange. That $3.3 million check is held by the QI. You never touch it. You now have 45 days to identify and 180 days to close on your replacement property. You meet Marcus, the veteran commercial broker you hired based on your previous 12-unit deal. You present him with the qualified intermediary's commitment. Marcus takes you seriously. He shows you the portfolio that isn't listed publicly. You utilize the 1031 proceeds of $3.3 million as a standard 30% down payment. You finance the rest with an investment-grade commercial bank loan. You acquire a single, stabilized, high cash flow commercial asset, a 64-unit garden-style apartment complex in an A-class school district. Purchase price? $11 million. Look at the high finance outcome of the 1031 pivot. First, you deferred $800,000 in immediate tax liability, channeling that entire sum into a compounding asset. Second, you traded 28 high management doors for 64 high efficiency doors, institutional grade. Third, you minimized operational noise. 1 manager, 1 HVAC contract, 1 roof, high margins. Fourth, you utilized $1.5 million in forced equity from the BRRRR years to acquire an asset whose value is now exponentially scaling with the accelerating economy of the A-class market. By 2023, you own 64 high-quality institutional units. Your portfolio value hits $15 million. Phase 4, Institutional Optimization. $15 million to $30 million plus. At $15 million, you are no longer an investor. You are a quiet institution. You have all this capital, but your central nervous system is still calibrated to the cortisol levels of when you were 24, standing on that toilet with soaking wet gloves. That past humiliation is the quiet fuel that powers your ultimate discipline. Your primary focus is not expanding further. It is debt and cash flow optimization. You must transition to Phase 4, the institutional refinance loop and the Perpetual 1031. Your new 64-unit complex is generating massive net cash flow. It has been stabilized for 2 years. Its commercial value has climbed with NOI. You are now in discussions with a regional private bank that specializes in advanced portfolio refinancing. You cross-collateralize your new institutional asset. The bank performs institutional underwriting, focusing solely on the debt service coverage ratio, or DSCR. The bank appraises the property. Value, $19 million. Equity, $8 million. The bank executes a structured 70% loan-to-value commercial portfolio refinance against the 100% equity position. The bank issues a check to your LLC treasury for $4.2 million. Look at the arithmetic of Phase 4. This is the ultimate BRRRR method applied to an institutional Class A complex. You just manufactured $4.2 million in clean 100% tax-free liquidity back into your treasury account. You still own the 64 units, but you have pulled your original investment off the table. Finally, you utilize that $4.2 million liquidity to fund your final 1031 exchange. It is 2026. Marcus, your broker, approaches you with a high-stakes A-class offering, a newer, high-efficiency, fully leased medical office campus with long-term institutional triple net leases in place. Value, $14 million. This is the ultimate detached play. Medical office, no residential toilets, 100% corporate liability. You sell your stabilized 64-unit complex for $19 million. Net equity proceeds of $11 million are handled by the qualified intermediary. You execute the clean Perpetual 1031 pivot. You acquire the $14 million medical office campus using the 1031 proceeds. Look at the final result of the machine. Your personal holding company now controls a diversified commercial portfolio, the original institutional-grade residential complex, and a new high-efficiency medical park. Combined institutional asset value, $33 million. You are standing on your childhood porch. Your old gray pickup truck is at the curb. You're in a plain navy sweater, dark jeans, and simple boots. You are holding a paper cup of coffee. From this vantage point, you look unremarkable. Around you, the neighborhood is awake. Mrs. Gable is watching the neighbors wash their leased luxury SUVs, which she thinks represents the economy of the block. Nobody on this street has any idea what's actually happening. Others thought wealth was about status signaling, leasing flashy cars and shouting from behind a mahogany desk to prove his status. You learned that real power is about mastering the math, staying patient in the duplex, and engineering an institutional machine so quiet and efficient that you can silently acquire $30 million in commercial dirt without using a single dollar of your own saved income. Unremarkable, quiet,